Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look across markets, giving you a bit of a market update, talking about what's coming up in the week ahead and what sort of market plays could happen. So I actually want to start with the US dollar index. Let me get rid of these old annotations. These are one-day candlesticks, and as you can see, we've seen a fairly decent pullback from the mid-July highs. We're down, about 3.5% now versus those earlier highs from in July. Why have we fallen back? Well, since mid-July, we've seen two things really that have driven this. Increased evidence of global economic weakness, but that includes in the US. Including that data last Thursday, which showed that the US economy was in a technical recession in the first half of 2022. Other economic indicators like PMIs that we've recently had have also been pretty ugly, and we've got a lot of data coming out this week, which will give further inputs to that weakening US economy sort of narrative that's been building. And because of this building idea that the US economy is going to be suffering, we've seen markets quite aggressively pull back their Fed tightening bets. And not helping that was the fact that the Fed sort of came across a bit more dovish last week. Like, instead of coming across with that super strong conviction that we need to continue lifting interest rates at an aggressive pace to control inflation, they did say that further interest rate rises would be appropriate, but they said that they'd be taking things as they come. Suggesting a slower pace ahead is a strong possibility. And they also didn't push back at the idea of rate cuts in 2023, which seems a bit crazy when inflation's as high as it is, and inflation is still probably going to be pretty high in 2023. So it seems a bit mad that they'd be thinking about rate cuts. But I mean, if they are more worried about growth, then it's a possibility. Here's a possibility, but that's a pretty toxic combination for the dollar. Fed bets being pulled back. People pricing in a recession. And then you've also had a big rally in risk assets like stocks and crypto. Really, really good earnings last week from some of the big names like Apple and Amazon and Google and, some of the other names, which helped power stocks higher. The US dollar, safe haven asset, so it's been coming under pressure because of that. And you can see we've fallen through this area of resistance here, which in the past, when we broke above it, I was thinking, when we fall back to 105.50 or 105, that might be a nice area to reload on longs. But with the current narrative about the weakening US economy and the dovish Fed pivot, I don't think it's appropriate yet to be trying to buy the dollar to go higher. Could be wrong. Maybe data this week is going to be strong, and maybe Fed speakers are going to sound a bit hawkish. In which case things could quickly reverse, but it seems to me that we're probably going to test this 50-day moving average, which is, not much further to the downside, really. Driving most of this move in the last 3 sessions has been dollar yen. Look at these big moves to the south in dollar yen. How much have we fallen from the mid-July highs? Wow, about 5.5%. Big moves in dollar yen. It looks like we are really, really gunning for this support resistance area, or resistance turned support area around 103.50. 131.50. Which we could hit today, maybe tomorrow. Probably going to hit at some point this week, though, you would think. All those things I've just been talking about, like the markets pulling back on their Fed tightening bets, the weakening US economy, and importantly for dollar yen, because it's very sensitive to rate differentials, we've also seen this pullback in US yields, which is sort of the main driving factor for this. Although people are also talking about how, in the last couple of months, the yen has been one of the most profitable currencies to go short. Well, this could be a short squeeze, and it could send us through this support quite easily. So just be on your toes for that, because you don't want to catch a falling knife. That's a dangerous strategy. Let's have a quick look at euro dollar. Euro dollar's a little bit more boring. You can see still within recent ranges. Why is that the case? Well, because the Eurozone's in an even worse position than the US. And markets have also been pulling back their dovish ECB bets. But, you know, we have had good risk appetite recently, like I was just saying in stocks. I'll show you the S&P 500 in a minute. And if that good risk appetite continues, then there's a good chance that we do see further euro-dollar upside, and we do test these areas of resistance, which I've been talking about now for what feels like ever. But yeah, we're going to have to wait and see, because some of the data we've had out of the Eurozone today, I think there was a contraction in factory activity, and then German retail sales was like the worst for, I can't remember how many years now, but it might have been decades. So it's difficult to make the case for like a big euro-dollar bounce. Let's look at the S&P 500 then. We've referenced it a few times. Yes, here you can see the big bounce on dovish Fed bets and on good earnings pretty much. Last 2 weeks have been very, very strong, or since mid-July anyway. Consolidating a bit this morning. Not only did you have that Eurozone data, which was not good, which I already mentioned, you also had Chinese data as well, like PMI data basically, that was not good. Shows that the recovery there is already hitting a wall, because I mean they're basically always in some kind of lockdown over there at the moment, because they're continuing with the zero coronavirus strategy. So recession bets a little bit at play here today, but I mean we also need a bit of consolidation after recent gains. I still think, you know, as long as the US data is still weak, continues to point towards a more dovish Fed, and earnings remain good, which they have been for now, I still think it's likely we're going to touch this high here from, when's that, late May. Yeah. And the technicals still look good, remember. Remember, we were in this downtrend. And, yeah, look, since we've broken above it, boom, bounced at the 50 DMA. You know, technicals have been looking good, so I think this can continue to go. And something that could help that is oil. Look at this drop. Wow. This is on the weak data that we just had out of the Eurozone today and China, obviously sparking fears about the demand outlook. And look at this. This is important. We've gone below the 200-day moving average, and if we can hold below the 200-day moving average and get below these sort of support areas from like March and April, and then obviously this recent low as well, I think there's a very good possibility that oil is going to continue heading lower within, I mean we kind of chopped through this downtrend recently, but it's been a pretty good guide to the price action in the last couple of weeks. And I think, as I've been saying, I think I said it last week and the week before in my Monday video, I think we can keep going to the downside. And, you know, my target would be, where's that? Around 85. These highs here. That would be a good area of support, I think. And downside in oil will help reduce inflation fears, which could be good for the S&P 500, and it could help it hit that late May high that I was talking about. And it could also weigh on the dollar as a result of risk appetite, and also as a result of Fed tightening bets being pulled back on, because obviously, you know, when energy prices are coming down, it reduces Fed concerns about inflation, means they can not have to be as hawkish, basically. But let's quickly finish off by looking at the calendar. So, ISM manufacturing PMI today, that's going to be important. Let's just quickly talk about the US data. Then ISM services PMI on Wednesday, and then on Friday you've got the official labour market report. All this data is all being looked at in the context of the weakening US economy and the outlook for Fed tightening. Okay, so if it results in reduced Fed tightening bets, like I've been saying, could be good for risk appetite, and vice versa. We've also got quite a busy calendar for other events though. RBA. That'd be good for the Aussie traders to watch. Kiwi jobs data only comes out once a quarter. That could result in some chop for the Kiwi. Bank of England on Thursday. That'll be a big one. We're expecting probably 50 basis point move. But, you know, we're going to have to wait and see. And then Canadian employment data as well on Friday. So another interesting one. But yeah, guys, that's pretty much the video. Hope you enjoyed it. Hope this helped for the week ahead, and I will see you all in the next one.